Welcome back to the weekly portfolio update video. As the world continues through these trying times, as the stock market proves just how unpredictable it can be, with the red and green days testing all investors. Amidst all the news, a company I really wanted to highlight today is the Chinese tech giant that is Alibaba. Alibaba on Thursday reported its slowest quarterly revenue growth since going public and missed expectations, but the Chinese e-commerce giant did beat on earnings. Here are how Alibaba did in its fiscal third quarter. Its revenue was $242.58 billion, which is equivalent to $38.06 billion versus the 246 billion yuan expected, a 10% year-on-year rise. Earnings per share 16.87, $2.65 yuan per share versus the 16.18 yuan per share estimated, a 23% year-over-year fall. The 10% revenue growth is the slowest quarterly year-on-year growth rate for the company since its 2014 US listing. Alibaba shares dropped in the morning, but then curtailed their losses. The company ended Thursday's trading session down 0.7%. Alibaba has been facing microeconomic headwinds in China, which have weighed on the e-commerce giant's business. Chinese retail sales remained sluggish in the fourth quarter of the year, for example, and there is heightening competition in the Chinese e-commerce space. Meanwhile, the company's shares have fallen over 50% in the last year, as China tightened regulations on its country's technology sector in areas from antitrust to data protection. Last year, Alibaba was hit with an 18.23 billion yuan fine by regulators as part of an antitrust investigation. Scrutiny on China's tech giants continues, which is another factor weighing in on the company. Our current share price does not fairly reflect the value of the company. At current price levels, we plan to continue our share repurchases. At the same time, we will maintain a strong cash position that gives us the financial flexibility for future investments, said on the earnings conference call. In the December quarter, Alibaba bought back approximately 10.1 million of its US-listed American depository shares for around 1.4 billion. Its share repurchase scheme will expire at the end of December 2020. Investors are watching a few key metrics including customer management revenue, cloud computing revenue, and company's forward guidance. In the December quarter, Alibaba further broke down the way it was to report future results for different segments of its business. Instead of core commerce, the company will now split up into China and international retail businesses into different reporting categories. It has also broken out figures for its logistic arm, K-Now, and local customer service, which includes its food delivery platform, and Alibaba has started to report adjusted earnings before interest, taxes, depreciation, and amortization for each segment. Under its China commerce business, customer management revenue is a key metric for analysts. It is the single biggest portion of Alibaba's revenue. CMR came in at 100.09 billion yuan at a 1% year-over-year fall. CRM is revenue Alibaba gets from services such as marketing that the company sells to merchants on its Taobao and Tmall e-commerce platforms. During the December quarter, China had its annual single-day shopping festival, a multi-day extravaganza in which retailers offer huge discounts. Alibaba said gross merchandise volume during the 11-day period hit a record 540 billion yuan. But GMV, effectively the amount of money transacted across the platform, does not translate into direct revenue for Alibaba. Profit for Chinese commerce fell around 20% year-on-year to 54.47 billion yuan. Meanwhile, revenue for the company's international commerce business grew at 18% year-over-year to 16.45 billion yuan in the December quarter. Alibaba said the percentage of customers from less developed areas has continued to grow. The Hangzhou headquarters company has been focused on penetrating smaller Chinese cities to find new avenues of growth. It has launched a product called Taobao Deals, which offers discounted products to help with its aim. Alibaba has paid orders on Taobao deals grew 100% year-over-year in December quarter. Cloud computing revenue for the December quarter came in at 19.54 billion yuan, up 20% year-over-year. That was slower than the 33% growth seen in the September quarter, but losses for the cloud division narrowed. Two factors have been weighing on the cloud business results. TikTok owner ByteDance has continued to move its overseas operations off Alibaba's cloud products, whilst China's regulatory crackdown on sectors including gaming and education, key customers for Alibaba, will also weigh on results. But the company has continued to diversify into customer bases to other industries. Revenue from non-interest industries accounted for 52% of the cloud revenue. In the face of rising competition, Alibaba has looked to grow some of its newer businesses, such as food delivery, which is under its local consumer service division and includes other products, such as travel app Fliggy. Revenue for the local customer service came in at 12.14 billion yuan in December quarter, up 27% year-over-year. For food delivery service L.me, Alibaba said unit economics per order improved year-over-year, driven by disciplined user acquisitions, spending, and reduced delivery cost. However, losses for the division overall widened. I must clarify that I am an Alibaba investor, and this news and article does add negative outlook on my position. Many great investors have spoken on Alibaba, and many great investors have put their money on the line for this position. Charlie Munger has basically become a staple for this stock now, and a safety blanket for all investors, seeing an investor of his stature not just speaking on the company and how he trusts them, but adding to his position as it falls is reassuring for many investors. When I opened my Alibaba position, it was after the stock had already seen a pretty drastic fall, and I got in on the 26th of August at around $170 per share. I looked at it as a way to diversify into another country and invest in a growing company with an amazing runway for growth. The stock continued to fall, and I bought small increments, and now my position is worth $508 and down 35% or $274 with an average share price of $165. Overall, I know that normally when a stock I invest in falls, I see this as a buying opportunity, but at the moment, I want to keep my funds elsewhere. I still have some hope for this position, but the constant negative news that continues to come out whenever I check on the company is concerning. I plan to hold on to my position and see how it pans out in the future, but I don't plan to add to it. Overall, I still see the runway for growth in this company, but as I learn more as an investor, I feel more comfortable not investing in Chinese stocks and allocating my capital elsewhere, where I can go to sleep at night knowing my position will still be there in the morning. Going through my portfolio, I'm up from last week as the market has been pulling back up. Tech stocks continue to rise, and since my portfolio is so heavily weighted in that sector, they have a large influence on my performance. I'm a little tight for money right now, which is horrible because this has been a great time to buy companies I believe in at a discounted entry point. I will hopefully be able to put some money in soon and increase a few positions. Hopefully this video has helped share some insight into what is going on with Alibaba as the company and the stock, and what I am doing with my position. Leave your thoughts in the comments and leave a like if you enjoyed, and subscribe for more weekly business content.